Olix Network 18, Mission Poshan, Bhavishya Roshan.
Allahabad High Court has directed the Finance Ministry to meet the Reserve Bank of India and power companies.
The Honorable Court has given an opportunity for all sides to come together to see what solutions can be found.
States know that if they don't pay, the RBI can make direct deductions. Okay, there's a tripartite agreement. The very fact that agreement exists, enough deterrent for state to pay.
ICICI Bank whistleblower levels fresh allegations against Chanda Kochar.
It alleges that the SR Group round-tripped investment payments to New Power Group via their company First Land Holdings Mauritius.
Are we going to get the first rate hike in 4.5 years?
We're coming into an election year, and if the government gets the feeling that RBI is actually holding back growth, you may see a reaction on the other side, which will undo whatever RBI is trying to do.
With the U.S. adding 223,000 non-farm payrolls in May, according to the Labor Department, that was well above estimates.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me is Sonia. I'm missing Anush for more than one reason today. I mean, this is a huge bull market that the US numbers have unleashed. When there is growth, I mean, you know who's the boss. You can have interest rate hikes, you can have commodity price hikes. It really doesn't matter if growth is firing. And that's what the US jobs data has shown. And you can see the reaction. Look at the Nikkei, up about over 300 points. It's just set all risk assets on fire. And what's great about this bull run from an India point of view is that every risk asset except oil is higher today. And that's because there was record production of oil from the United States, equaling Russia's actually. And that's taken the per day production to 10.47 million barrels. Of course, we'll have Manisha here to tell us more in a bit. But this is a record oil output. Suddenly, two of India's biggest problems, the current account deficit and the fiscal deficit, look smaller because, you know, crude from 80 to 76 is quite a fall. And more importantly, if growth is firing, then our exports will fire sooner or later. So today, I think India will take cognizance of all this.
Okay, and we have so many cues to discuss, right? Lata, hi, good morning. Of course, this week there will be the RBI policy, and I think for the first time in 4 years, there's an expectation of a rate hike. But Nomura put it, you know, they said that the possibility of a rate hike now is inevitable. So it's just about timing when it comes through. I mean, is that the market expectation as well? The important point is that this time the RBI is following the market. You know, on Friday, all banks raised their interest rates just by 10 basis points. But the yields year to date have gone up by 140 basis points. If you looked at the yield of anything, commercial paper, 10-year bonds, 2-year bonds, I mean, you name it, any debt instrument from Jan 1st to today, the rise in yields is about 140 basis points. So the Reserve Bank, if it hikes, is only following the market. There is no need for any fresh negative reaction unless it is accompanied by a very hawkish statement that, you know, this is the first of many more rate hikes to follow. If there's anything in the language which gives you that feeling, only then it's negative. But separately, since you spoke about banks, normally when there is a growth kicker, banks would do, Nifty banks should do very well. But today, you know, there's going to be a dichotomy. HDFC Bank will obviously do well because the window has opened. Yes. So it will just lead the charge, and so will retail banks. But two or three of the other components, and we will discuss that in top 10, like ICICI Bank has a whistleblower problem. Yeah. BOB has this report in Mint, which is so bloody confusing that they're going to be merged. So, you know, this is a great day for Nifty Bank and banking stocks, but individuals perhaps will not be able to participate because of stock-specific news. Okay, but at least for now, the expectation is the market will start off in the green, not just because of the positive cues that we have, but crude has fallen so much as well. I mean, crude is down more than 3% in the last 1 week, so that's looking pretty good. But let's kickstart the week on that note. We have lots on our plate, and here's what our wise experts have to say as we head into trade this morning. Gautam Chowcharia of UBS says FY 19-20 consensus Nifty earnings estimates were cut by 3% and 1% during the earnings season, which was broad-based across most sectors. He says consensus expectations of a 20 to 21% growth in Nifty earnings for FY20 are very optimistic, and he expects a 6 to 10% top-down cut. He says markets are not pricing in these cuts given the valuations.
Actually, this is very important, and I guess Nimesh will be joining us shortly to tell us how many brokerages have cut earnings at the end of the fourth quarter? It didn't look so bad because it was coming off a demonetization quarter, but clearly expectations were higher than what was delivered. We'll come to that in a bit. Nimesh will be here with the numbers, but let's get you some more money market views. Pramit Brahmabhat of Veracity says, on the back of spot crude prices, soft crude prices, as well as positive global cues, the rupee will appreciate towards 66.80. He expects the spot USD INR to trade a range of 66.80, 67.20 to the dollar.
And Ajay Magnolia of Edelweiss says, while crude and currency remain the key near-term drivers of the yield trajectory, the focus this week will be on the MPC review, the Monetary Policy Committee, where the markets are bracing for hawkish commentary, along with the uncertainty of an early rate hike. He says, as a result, participation is expected to be very muted as seen on Friday, without much positioning ahead of the Monetary Policy Committee. He says the 10-year benchmark bond yield is likely to trade in a band of 7.82 to 7.88% today.
Okay. Well, it did end at 7.85 on Friday itself. Well, but there are a lot of positive global cues, so over to Nigel for the world view.
Well, that's right. The U.S. markets ended well in the green in Friday's trading session. The Dow hit a double century, was up 220 points odd. Remember, the key reason was that the jobs report looked better than expected. So the number of jobs added were far more than what was expected. The hourly wages as well did spike up. And in fact, the unemployment rate, that's at the lowest we have seen in the last few years. So pretty good going there. Banking stocks did well. So a whole host of those banking gainers should come up for you. The likes of Goldman Sachs, Bank of America as well did well. And Morgan Stanley as well did end well in the green. While you have some of these tech-related stocks as well, that did very well. That explained why, in fact, the Nasdaq did outperform. So you had a whole host of them. Apple, Facebook, all of them did run along. The bond yields, well, they've cooled off to around 2.9% odd. So that's a bit of a positive as well. And the European markets, all the three frontliners, they ended with good gains. But the real action was in the other couple of markets. The Italian and the Spanish index, there was a bit of a resolution going out in terms of the political instability out there. So both those markets ended with gains of more than 1%. Asian markets this morning, the Japanese index is doing well. We have seen that the yen is moving back towards that 110 odd mark. So good news. Other Asian markets as well trading in the green. Crude prices holding below $77 per barrel. That's a positive. And in fact, the SGX Nifty is indicating nearly around 40-50 points just to kickstart trade. Back to you all.
Okay, thank you very much, Nigel, for that. Today, global cues are going to dominate the Indian mind space as well. And that's because of the US jobs growth. That looked really strong at 233,000 against market expectations of 188,000. James Glassman, senior economist, JP Morgan, joins us on the phone line with us today. Thank you very much, James, for joining us on what's a Sunday evening for you. But tell us, I mean, would the markets now be willing to add to the market's already rich valuations, especially in the developed world?
Well, I mean, I think the U.S. news is telling you the economy is quite strong. The performance, the earnings are really quite good. The main problem has been uncertainty about the trade issues. So I think the market has the potential to do better if we get some clarity on the trade negotiations that are going on. So yeah, I think it's still a very positive environment. And even though this news on the U.S. is pointing the way to further rate increases by the Fed, I think it's all viewed by the market, I think, as a constructive backdrop.
Okay, so constructive backdrop, the possibility of a further rate hike as well. You know, talking about higher rates, James, it seems like that's the order of the day here in India as well. We have the RBI policy later this week, and there is an expectation for that for the first time in 4 years, rates could perhaps be hiked. How are you approaching the Indian economy and the markets now?
You know, I think if the global economy is in good shape, higher interest rates are not really a threat to most regions because these interest rates have been held down by central banks, so they're artificially low. And we're not talking about central banks trying to slow things down. We're just talking about central banks slowly removing this accommodation that's been in place for the last 10 years. So I think it's a generally favorable backdrop. I mean, some people worry that, well, higher interest rates in the U.S. might be a bit of a headwind for emerging markets, but I think more important than higher interest rates, I think, is if the developed economies are strong, then I think that is a much more helpful force for India.
Okay, yeah, James, what one worries is, first of all, does this make the case for developed markets, especially the US, much stronger? So could there be an outcome of higher bond yields and higher, stronger US dollar? After all, Europe has its turmoil, not just in growth, but also political. So can this take the dollar back to 95 or anything like that? That's the only point we would bother. Otherwise, growth, of course, is welcome.
I think the instability in the European region is a worry in the market's mind. But I think, all of these things that we're talking about are really well known in the market. Yet
okay.
The surprising thing is that we see very low interest rates still. The bond yields are relatively stable. So I think a lot of the things that we worry about, they're in the background. But I think what the market's telling you is that there's still some issues.
Okay. So how many rate hikes, though, from the Fed you would imagine? There's one in June for sure.
In June and probably September. And I think more important, the idea that the Fed has is they want to get interest rates back to something more normal. In their mind, normal is somewhere close to 3%. And I think they have an intention of getting there by the end of next year. Okay. So in a very slow, gradual way.
All right. We'll leave it at that. James Glassman, thank you very much indeed for joining us on a Sunday evening for you. So as James puts it, the market already knows that rate hikes will come. In spite of it, that good cheer for growth is positive. We have an expert from our own, from the Indian markets joining us. K.K. Mistry, Vice Chairman and CEO of HDFC, joins us on the phone line. Good morning, Mr. Mistry, and sorry to disturb you on your vacation.
No, morning, Lata.
Well, you all have HDFC has increased lending rates, and so have a whole slew of banks on Friday. What does this mean? Will this impact demand at all? What kind of loan growth do you foresee?
I don't see a 10 basis points change in interest rates impacting demand. You have to also understand that there are tax benefits associated with a housing loan. So when you raise the rates by 10 basis points, the actual cost to a customer does not actually go up by 10 basis points. It goes up by about 6 or 7 basis points, depending on where your tax liability is structured. So I don't see it impacting demand. And the reason everyone has raised rates is because liquidity in the system is significantly lesser than what it used to be. And you can see that reflected in bond yields also. And more than that, you can see it reflected in the fact that liquidity has really slowed, has really sort of become very, very tight.
Okay. Mr. Mistry, good morning. This is Sonia here.
Morning.
What is your expectation then with respect to what the RBI could do later this week? I mean, everyone's talking about the possibility of the rate hike. You think the central bank could be preemptive given that, we have worsening macros?
I would think that there is a reasonable chance that RBI can increase rates by about 25 basis points. There is a possibility. Whether RBI will do it right now or wait till the next credit policy is tough to say. But a couple of things you must bear in mind. One is that the monsoon outlook seems to be fairly good this year. So that should not be too much of a worry. On the other side, we have rising oil prices, which have clearly been a big dampener for India because we are such a large importer of oil. And also the fact that U.S. interest rates going higher means there has been an outflow of funds out of emerging markets and more so out of India. So we've seen so much of overseas money going out, both in the form of debt instruments as well as in the form of equity. So that has caused some degree of liquidity strain in the system. And RBI intervening in the forex market by supplying dollars further reduces that liquidity. So in that sense, it's reduced liquidity and therefore it's pushing interest rates higher.
Okay. Well, just one more word on this then. Do you think that more rate hikes can come since the cost of money in the wholesale market has just shot up? I mean, NABARD, SIDBI, none of them are able to raise money.
Yes, interest rates have shot up, so therefore one has to look more at other avenues of raising funding at a time like this rather than relying only on the bond market. So we are looking at other alternatives also besides bonds. We are focusing more on a retail deposit, number one. Number two, we are focusing also on some kind of external commercial borrowing. These are a couple of things. And plus, you must remember, we raised equity some time back.
Okay.
So that has also helped.
Okay, Mr. Mistry, since we have you with us, I just wanted to understand whether you believe that the economy is in a cyclical recovery. I mean, a lot of experts tell us that the twin shocks of Demon and GST have now been dusted off. But what's your own view?
Oh, absolutely. There's no question of a doubt about it. If you see the micro data that's coming out, corporate earnings are a lot better than what they used to be. GDP numbers are better. So overall sentiments are a lot better. So there's no question of a doubt that the micro data is clearly showing the significant recovery.
Okay. So, just to come back to the, how much more can the cost of money rise, say, in the next 1 quarter or two? For you, I mean, can you raise MCLR by what, 10 more bips, 25 bips more?
It's very difficult to answer because it's purely a function of how funding cost is going to pan out over time. We'd obviously try to diversify our funding sources, which is what we've done consistently over time. Rely more on deposits, rely more on other avenues of raising funds, maybe masala bonds, maybe international funding. So to that extent, we will cushion the impact of the bond market.
Okay, one final question. We are given to understand HDFC Bank is seeking shareholder approval to buy more loans, acquire more home loans from you. So is that first of all true? And secondly, therefore you must be very confident of your own loan growth numbers. How much would they be?
Well, I can't comment on loan book growth numbers, but if you see last year, HDFC Bank did not buy any loans.
Okay.
So the on-balance sheet loan book growth was 23%. But we've always guided investors towards the AUM growth. And the AUM growth on individual loans was 18%.
Okay.
So whether HDFC buys loans or not, does not buy loans, the AUM growth does not change.
Okay.
So you should look at AUM growth. Now, what they did not buy last year, in all probability, they will buy this year. But that will not alter the AUM growth.
Fair enough. All right, Mr. Mistry, we'll let you enjoy your vacation. Thank you very much indeed for joining us.
Thank you. Bye-bye.
All right, so expect maybe more masala bond and that kind of raisings. Expect their FDs to come out. As he said, we will depend on retail money. So that's always an attractive proposition for those who don't have the stomach for stock market risks. And HDFC FD usually offers a little more for senior citizens.
Yeah.
It's very lucrative.
Absolutely, that's in demand. But also expect a rate hike this time. I mean, you can't rule it out. He's talking about the possibility of a 25 basis points rate hike. We'll take a short break on that note. But up next, a big market voice will join in to decode what looks like a big market day. Arvind Sanger will be with us next.